This is Robert Kraft, and I'm your host for the SNN Network virtual conference. I'd like to thank you all for joining us today. And we have a really special panel, roundtable, keynote, whatever you want to call it. I'm just stoked that all these people are joining us today for this really cool conversation. And we're calling this the Willow Oak Roundtable. For those of you who may not know about Willow Oak Capital Management, Willow Oak is a flexible platform of private investment partnerships that are independently run by unique internal and external fund managers, uncovering uncommon opportunities. Willow Oak offers operational support to our fund partners through tailored fund management services. So with that, I'd like to introduce everybody who's joining us on the Willow Oak Roundtable, starting with Stephen Kiel, who serves as portfolio manager for Arquitos Capital, which he launched in 2012. He also serves as the president of Willow Oak Capital Asset Management. Stephen, give us a little, or this, or I don't know.
Thanks, Robert. I mean, those intros right off the cuff is great. Making up as
well,
you
look,
go along.
I got to tell you, there's a lot that we're going to cover today. I think so. I figured let's just get after it. You know what I mean? So
yeah, happy to be here.
Cool, thank you. And next up, we have Keith Smith, who is a corporate valuation expert and CFA. He is the portfolio manager of Bonhoeffer Fund, having co-launched the fund in 2017. Keith, thank you for joining.
Yeah, thanks a lot, Robert. It's a pleasure to be here. Just look forward to this interesting discussion. Like you're saying, my background's primarily in, I've got an engineering background, so I've got sort of a combination engineering valuation background. This has been a very interesting time in terms of some of these new companies with different models and thinking about that through history. And that's another area that I enjoy talking about. Hopefully we'll talk a little bit about it in terms of the history and what's really going on here in terms of what's really happening with companies and models and people that are using different valuation models over time. But pleasure to be here, and looking forward to it.
All right. So note to everybody on the panel, we're asking Keith the hardest questions today. He set himself up for that, and that's just what's going to happen. So we also have Dave Waters joining us as well. He is the principal of Alluvial Capital, offering clients and partners investment opportunities through separately managed accounts and a private partnership, Alluvial Fund. Dave, how's it going? What's up, OTC Adventures?
That's right. Still doing that blog all these years later. Really happy to be here. Excited about the conversation. Thank you for hosting.
Very cool. Now we're going to our podcast professionals. I've just upgraded my equipment today so that I can at least be a tier below these two gentlemen. So in addition to hosting the popular weekly podcast, Geoff, Gannon, and Andrew Kuhn offer clients investment opportunities through managed accounts and a newly launched partnership-focused compounding fund. And you must go and listen to their podcast. It's one of the best out there. They're having a lot of fun. Andrew, Geoff, thank you for joining as always.
Thanks for having us.
Yep, thanks for having us, and proud of you for upgrading your equipment. You run a great show, and you look good. The camera, the quality's great, the audio's great, the webcam's great. I'm proud of you.
Oh, you guys,
thanks so much for having us on.
You don't understand. That really means the world to me right now, and I feel like I can if my media career were to end tomorrow, it would be a very happy ending. And who knows, it might. I hope not. But anyways, let's dig right in. Enough of the terrible jokes. There will be more, but enough of them for now. One of the first things I wanted to cover on this panel is everyone's experiences thus far in the first 7 months of 2020. So much has happened. Almost all of it has been unexpected. I think we can agree. And so I'd love to hear everyone's perspective. Let's start first with our boys at Focus Compounding, because they've been really putting out the content covering what's been going on as well from their perspective. So guys, you want to start us off?
Sure, go for it. So it was when everything started happening, we actually switched our podcast schedule from, I think at the time we were doing maybe twice or three times a week to we started just doing every single day. And I think it was just because there was so much that was happening every single day in the beginning of the year, or when everything, was starting to shut down. And it was, a pretty interesting time. And it'll be, interesting in the future to go back and kind of listen to our thoughts on that day by day. But it wasn't boring. I mean, would you say that, Geoff? It definitely was not boring.
Yeah. And we switched to doing the podcast not in person in mid-March. Mm-hmm. So yeah. That was our reason for doing that. We had to learn how to do Zoom and stuff. Yeah.
Yeah. But it was, every single day, it was just stuff was going on in, every company. It didn't matter if it was microcap, large cap, OT. I mean, it just didn't matter. Every company was just, participating in what was happening. So it was just a fascinating time in the market.
Yeah. I mean, what was like the 1 to 2 things that you kept seeing happening over and over that where maybe you had to adjust your due diligence process? Just what were some of the things that kept happening over and over again that you started to make note of? And you're like, okay, we need to pay attention to this, as we move forward.
So we actually owned a stock, Points International, which we had bought really recently before COVID happened. Or actually, there had been maybe 2 cases of COVID or something in the U.S. when we bought it. And it is a company that sells airline miles. In fact, it makes promises to buy the airline miles from airlines. So it was interesting owning that because we decided to sell it because of concerns about that. And the airlines had come out and had their earnings and saying it would be bad, stuff like that. But they actually reaffirmed their guidance. And so this was a thing that was happening all the time where the earnings that they were reporting were good for companies coming out, right? Because they were basically reporting earnings that only included a week or 2 of COVID. At the same time that you might be selling things or really worried about things because of what was coming ahead.
Mm-hmm. And I would also add, so that situation was interesting too, because when we purchased it, I don't know if I brought it up or what, but we were kind of doing like a pre-mortem, if you will. And I was like, okay, so how do we just completely, like, how does this investment just not work out at all? Even before everything was, I think at this point, it was before everything was happening with COVID. And I think one of the things you mentioned was, some sort of 9/11 event, or some sort of like global pandemic. And we were just kind of thinking through the odds of that actually happening. And it was just kind of weird that, a couple weeks or whatever later, this was actually happening. So it's something that we had to really follow pretty closely.
It's amazing that you even thought about that risk potentially. And I mean, because I'm pretty sure almost everybody who, whether they own that stock or any others that were, airline or travel adjacent, were like, because we all thought like, okay, markets run up, it's a 12-year bull market, there must be something that might happen. But I don't know I don't even think 538 predicted a pandemic.
Yeah, I'm a warrior. So I worry about a lot of stuff, and I could put context to it now because we talked about recently on the podcast, Tillman Fertitta's book. He says, I don't fear anything, but I worry about everything. And I was like, wow, that's me. So I was talking to Geoff, and I always ask him, I'm like, let's pull ghosts out of the wall. Like, how does this completely not work out? And so we were just going through, different scenarios, and it was just ironic that one of them actually happened,
Yeah,
unfortunately.
But even then, we didn't expect a pandemic to cause that much drop in air travel because we didn't expect the government all around the world, governments to do what they did this time versus what had happened in the last like 2 or so. Yeah.
Mm-hmm. And we were able to take advantage. They were going to report earnings the next day, and there was just a ton of volume, and we were able to take advantage of that volume and ultimately get out. And the stock, I think it ripped the next day, and we're like, they're reaffirming their guidance. I mean, we just, quite honestly, we didn't exactly trust that. And
yeah, that was just very lucky that way because for whatever reason, the market responded very positively to their earnings stuff and all that. And,
I guess the logical next question is whether or not they did actually follow on their guidance, but I'll leave that to whether or not you want to answer it or not, of course.
Yeah, well, I mean, so far they haven't changed things the way that airlines have. We'll see what they report in terms of what actually happens, but so far they maintain guidance for the year-end stuff, which I don't know how that's possible, but maybe people will buy airline miles even though they're not flying. I don't know.
For sure. All right. Well, I want to get to Keith now. Same question. How's been your experiences thus far this first 7 months into 2020?
Well, for me, it's really broadened out and thinking more about disruption. I started thinking and discussing some disruption in my quarterly letters towards the end of last year and in the first quarter of this year. But then it actually hit. And what does that really do? I mean, there's a very interesting chart put out by this guy, by the guy that runs over at Shaw Spring, Dennis Hong. He has this chart that shows how e-commerce is basically, it was very steadily going up. And then in the last quarter, it jumped like 30%. So what actually happened is you had a sort of compressed period of time when a lot of companies were becoming disrupted. And so the real question is, okay, you have this acceleration, and it really first, one of the places where it first manifested itself that I had seen was in some of the credit markets. So if you look at some of the mortgage credit markets and stuff like that, those ones were really hit pretty hard. And then over time, it hit specific sectors. But the other thing it got me really thinking about was, okay, I've got a good portion of our portfolio is in special sits, and those situations are basically going sort of are independent of sort of what's going on, but some of the underlying economics of the businesses are clearly affected by sort of this acceleration. And how is that really going to affect the overall business, and how that going to work through? I mean, especially in areas like right now, we hold a company that's in sort of the broadcast TV area, and that's quite a potentially changing area with competitors like Netflix and the other big media guys that are out there. And you sit back and you say, okay, well, this is, everything's been accelerated, and there's a lot of real, I think, uncertainty in the market, but it's not really being reflected. What's really being reflected, it reminds me a lot of 9900, where basically the guys with the new solutions are getting priced very high, but the guys with the legacy solutions are basically being valued really low, with the assumption that the new guys are going to kill the old guys. I mean, what I've taken out of 99 and even some time past then, for 08, 09 of some of these companies, is what happens in a lot of cases is that something happens in between, where the existing guys can continue to do well. They do better than when the market thinks that it's going to be. And the big guys, they do well, but not as good as the markets think they're going to do. So it's that type of sort of situation, I think. And in my mind, part of it was saying, okay, the other aspect I think of this, and we've described it in some of our letters, is, okay, a lot of these businesses now are similar to more like VC type businesses, where in essence what you're doing is you're not seeing it in the numbers, but you see it in unit economics. And then the big question is, sort of the mystery is, okay, can you take this unit economics and scale it up to a business, and it's going to work, especially in light of some cases where when you look at the numbers, the business economics looks really poor because they're continuing to pour money in. But the real question in my mind comes is, okay, can they really monetize this in a number of different ways? And it's an interesting thing, because you have companies that have just skyrocketed, assuming that their models are going to work without, at this point, I think enough, in many cases, without enough proof that it's actually going to happen. And so I think that's where the disconnect is, and where there's some real interesting opportunities now, especially amongst some of the stronger incumbents that have decent economics and that will continue to do well. I mean, you can get things like selling for 3.5 to 4 times free cash flow in some cases, which in essence, they're saying the company's going to die as a result of this. So, I mean, in my mind, I think that's sort of the corundum. I've sort of tried to think how to sort of incorporate these models, and how are they really going to affect some of these mainline businesses. So like in the broadcast TV area, we own a company called Great Television, which in essence is one of these companies where, in theory, I guess could be wiped out by this, but I see a lot of sort of hooks they still have in it. They get a lot of election earnings. They get a lot of these other types of earnings, and I think they're still going to be competitive. I think, Netflix is clearly one of the bigger leaders in streaming now, but I think it's not 100% clear that they're going to be the dominant guy. And it's a question of trying to balance those things out. So I mean, in my mind, our portfolio hasn't changed a whole lot. We've added a few names in areas that were pretty distressed, and maybe looking at things in a little bit different perspective, where we looked at some of the pipeline companies that may have had some local economics advantages, buying some maybe like car dealerships that have the same sort of thing. So looking at like companies that have advantages, but may have been, thrown out with the bathwater type stuff, where basically the market really is giving high valuations to companies that have this new business model versus the old. So that's where I think we found some opportunities, and we'll sort of see how it all plays out.
Absolutely. I mean, I'm going to come back to you because I want to know a little bit more about, because you mentioned in our very short intro about some of these new business models that are coming on, that are coming from some of these companies that just have to adjust, because we don't know how long we're going to still feel the effects of COVID. So I'm going to come back to you on that, because I want to go to Dave now to hear about his experience now for the first 7 months of 2020. Dave, everybody here is more or less a MicroCap or has some MicroCap exposure in their portfolio, but Dave is our OTC Adventures OG. So Dave, I mean, as a fund manager that really follows the MicroCap space and looking at random off the beaten path OTC stocks, I mean, what's been this first 7 months like for you?
I gotta say, does anyone else feel like they aged about a decade? Just this past 7 months? Yeah, pretty sure I have less hair than I did in January. Pretty sure my kids are getting a driver's license or something, because I haven't felt like this in a decade. I mean, what we went through in the spring of this year felt a lot like 2008, 2009, but worse, because it happened so much faster. I mean, at the worst, the market wasn't down as much as the S&P fell back then, but it happened in literally about a month, and it really hurt. And the pace of the recovery has been just as rapid, and probably caused about as many headaches for some fund managers out there worrying about how they look versus benchmarks. But of course, that doesn't matter too much in the short term. But I mean, the small stuff, the over-the-counter stuff, the unlisted stuff, did what it typically does. It held up fairly well at first for the first couple weeks, because they don't really get touched by people selling mutual funds, by ETF redemptions. But when the panic really starts setting in, people selling for whatever price they can get. I mean, I had stocks, things like that, where I would see, oh, the last trade was 15, and now half an hour later, the S&P 500 hit a new low, and now the bid is 12. And sure enough, someone comes along and hits that because they're convinced that the next bid's going to be 10. And you have to know that you're going to have experiences like that. There's going to be environments like that, and you have to be able to deal with it when it happens, but it doesn't feel good. That's for sure. And fortunately, we were able to make some good purchases of some deeply discounted merchandise during that brief time. But you don't do it without trepidation. You don't do it without realizing that this could easily be down another 20% if I buy this, and hopefully you have the cash left to buy some more down there. But that was incredible. And then of course the recovery's been incredible, and it seems like, but the recovery's been largely concentrated in large cap, very liquid companies. A lot of the stuff that's less liquid, that's smaller, has not fully participated in that rally. And to some extent, it makes sense. I mean, if we're now in a recession, or if the economy is going to stumble along for a little while, a lot of the times it is smaller companies that are hurt worse. But at the same time, it doesn't seem to matter the quality of the large cap company that's rallied. I see stuff with terrible balance sheets and deeply cyclical cash flows that's recovered, and even more sometimes, where on the other hand, you might have a microcap or an unlisted stock with net cash, a very, very stable business model that is still maybe 15 or 20% off the highs it hit in late 2019. So that's both frustrating and a buying opportunity, frankly. You can sit there and be mad about the fact that your stock is still down, even though the business is doing fine, or at least better than its peers, or you can open up your pocketbook and buy some more of the stock when it's on sale like that. And that's how I've been trying to think of it, that the decisions you make now will have a gigantic effect on your portfolio over the next 2, 3, 4 years. And take your eye off the index right now and don't worry about it. If you make the right investment and you buy the right stuff, you'll be fine.
Absolutely. I mean, gee, I'm no retort to everything you just said. I mean, especially when you're thinking of yourself as more of a contrarian and you're seeing the markets just getting destroyed, and maybe you have a watch list of companies that you're like, okay, if it dips under here, I mean, it's almost like, I don't want to say easy pickings, but I mean, it's kind of interesting to see what's been going on there. I mean, I could be wrong or right in that statement, but please tell me I'm wrong. I have no problem with that. But I want to jump to Steven now real quick to get hit. He's been a frequent guest on the Investors Roundtable. I invite everybody to go hear some of his thoughts that he's been putting out there for on a weekly basis. But Steven, for those who may not have heard some of your recent thoughts on your experiences thus far in the first 7 months, what have you been seeing? How have you been managing it? What's going on from your perspective?
The funny thing is that a contrarian position right now is investing in a company with strong balance sheet. I mean, it's a little bit insane, especially the small and the mid-cap companies. And to Dave's point, there is some trepidation. It's a great value. It's a deal. It's going to pay off in 2, 3, 4 years. but you don't know how much lower it can go over the next week, month, 3 months, 6 months, a year. And that's scary. Even as an individual investor, it's a little bit scary because you have a fear of missing out, that you could buy it cheaper. And also, look, any kind of investor, whether a portfolio manager or an individual investor, you look at your statement and it's down another 30%, even though you know what you hold is a great deal. It's still not easy. And so you have to build that commitment to the position while you're buying it, or maybe, you know, build it before you're able to buy it. And that's very difficult, even for these positions that you know are going to work out very, very well over the next several years plus. And it was a similar situation of the 08-09. Because of that, just the uncertainty caused the same emotional toll. The change here, though, is, like Dave said, this is so rapid this time around. And the fact that some of these companies, especially the small, mid-cap, strong balance sheet type of companies, they went down and they haven't gone back up yet. And that's a unique situation. I'm in a lot of those positions. I know all of us are in some of those, where we think they're in industries, they're specific companies that will survive and are taking this opportunity in many cases to thrive. But it's tough. And it really goes to show that you have to build that commitment and have that discipline to buy something that you know is cheap and be okay with it going down another 20, 30, 40%. And again, that's tough. And so what I've done is I've doubled down on some current positions, some watch list positions that I've held for years that I really know well, that I've just been waiting for an opportunity I've got into. But it's very difficult to just jump in late March and buy a company that you've only spent a few weeks of research on, because if it goes down another 20%, you're going to start to doubt your analysis. And of course, there's all the uncertainty given the moment as well. So yeah, I think this is a good time to find those companies that you know really well, followed for a long time, and you get in it, and then you just don't look at your statement for a while, quite frankly. So that's what we've been trying to do. You know, these strong balance sheet companies are the way to go. I think they're much safer, even though they've been left out so far. I guess the other point I'd like to make is it's very interesting that the timing of when everything happened here, the last 2 weeks, primarily of Q1. And so most of what happened was not really picked up in the Q1 releases. And then what I saw then come out, the Q1 releases come out, there were conference calls and commentary and things like that. And that commentary was still happening in an environment that was extremely uncertain. Their Q1 earnings were fine. That's when the market started to recover a bit, though. It really, was crushed beginning mid-March. It recovered a bit when the Q1 earnings came out. Generally, I'm talking in kind of a top-down approach here. And the commentary came out, and quite frankly, a lot of these companies with the commentary that they had with their Q1 earnings, they don't know either. And some of my holdings, they said, well, look, we're still plugging along, but there were some buybacks that were suspended, not because they thought that there would be severe degradation of their business, but just because they're conservative managers, conservative operators. And so they suspended the buybacks. And so, what's going to happen here is when the Q2 earnings come out and it's a full quarter, and they've started to come out a little bit, of course, but, over the next few weeks for the smaller companies, primarily that kind of file at the last minute, when those releases come out and there's commentary associated with it, it's going to be very, very interesting. And I think we could see another bout of volatility there. And that's when we might start to see that transition again, too. That's
a great segue to another question that I had to follow up on there, because one topic that we actually covered on another panel at this event, and I wanted to get everybody investor perspective here, is, you might start seeing some of that commentary of like, due to COVID, we saw a lot of downturn in our revenues. Whereas if you just looked a little bit closer, it's just an easy excuse, and you could be fooled into thinking that, okay, well, maybe this you're like, oh, this company, oh, yeah, the COVID. Yeah. That's why they're, as opposed to actually just being like, wait, no, they've been really sucking. Like, things have sucked. And so, I mean, what do you guys think about that? I mean, Steven, I'll throw it right back to you since you just said that. Well, not what I just said, but you're going.
That's an excellent point. And we're going to see, EBITDA C or something like that, EBITDA adjusted for COVID, and we'll pretend this isn't happening in our analyst estimates over the next year or two. All that stuff is happening, and this is an opportunity for certain managers to hide structural problems in their business, and also is a perfect and great opportunity for us as active managers, though, to see the babies that are thrown out with the bathwater, to try to look through and determine if some of those adjusted types of reports or different commentary is actually true or not. So I think, look, hopefully we see a transition back to the value in active management here, because I think long-term there is value in active managers. And, this is a way for us to show it over the next few months.
Absolutely agree. Dave, I'm just going to keep going. I'm going to go in clockwork and then back clockwise. So Dave, same question. I mean, as somebody who looks at, off the cuff OTC stock, I mean, you have that. I mean, everybody here has vast experiences digging into the 10Ks and the Qs and all their filings, but looking at some of these not listed companies, I mean, this, like Steven just said, this could be a perfect opportunity for some of those managers to kind of, hide behind some of their structural inefficiencies. I guess that's a nice way of putting it. So Dave, what are your thoughts on that?
I fully agree. One thing that's important to remember about a lot of these smaller companies is they can be extremely personality driven. A large company probably has an institutional culture and institutional memory. Oftentimes smaller companies, the person who's in charge very much sets the tone and sets the standards, no matter how long they've been there, or it's because it's a small operation. Maybe there's only a dozen people in the upper levels of management for the whole company. And so it's doubly important to insist on managers who are extremely frank and honest about the performance of their business. I mean, there's always an excuse out there. I mean, it's not always one as legitimate or as severe as the coronavirus epidemic, but you always have managers say, well, oil was high, or interest rates moved the wrong way, or there was bad weather in Texas, or something. There's always a reason why your business isn't performing as well as you want it to. But you don't want managers that are always coming up with an excuse for why they're underperforming. You want managers who identify those sources of underperformance and work to fix those and are honest about that process. And so, yes, I think this will be a good opportunity to get to know management a bit better and get to know the ones who distinguish themselves by saying, yes, we were affected by coronavirus, but this is what we're doing. This is what we did. This is what we'll do better going forward. And then you'll have others to say, not our fault. I deserve my full bonus. All the bad things happening here are due to COVID, and it's not me. So be watching for that for sure.
Absolutely. I mean, to your point, this is actually also a great opportunity for some managers to really get out in front of it, and just own like, hey, look, this, COVID or not, this is what happened in the business. This is how we plan on coming out of this. I mean, Keith, throwing to you, I mean, what are some of the things that you've seen on this front?
Well, I mean, I think one thing that's interesting is if since we've had this acceleration of time in terms of e-commerce and stuff like that, one of the key metrics I look at for a lot of distribution type businesses is inventory turns. I mean, it's a basic model, I think, and in my mind, it's the way I've looked at, just to give you a little bit of we talked a little bit earlier about sort of the history of valuation models, is you go back to the basic sort of Ben Graham screening kind of stuff. That's sort of like, and I'll do that to maybe sort of like Aristotle. You're talking very linear types of stuff. As you move forward, you have more of the Graham stuff, which is dealing with more of the dynamics of the business. And then now you're moving forward into stuff that, 7 forces helmet, where you're talking more about acceleration. And so you've got those types of things. So for example, like in a car dealership, one of the key metrics that I look at is inventory turns and the trends in those inventory turns. I mean, what you've seen in some cases, the inventory turns have actually gone up. Some of them have been lagging. And the real question in my mind, that's a key metric, because what it does, it says, okay, how fast am I matching my car to my customer? The more turns you have, that means you're shortening that period of time, and you're able to drive more volume through a particular dealership, and you can charge lower prices. You can take lower margins if you have a higher turn rate because your ROE is going to be the same or higher. So in my mind, that's a key aspect. And looking through this, I mean, there were some concerns early on of sort of car dealerships. They've done a real interesting, a lot of them have gone through sort of this big V. And some very interesting data early on in China was that in Wuhan, what they were actually seeing, and in China in general, was the increasing car sales after this thing fell down and it started to recover. And so I think that was something that's now being carried forward in a number of different markets. And so I think part of it is, if you follow the news, and the interesting thing about this pandemic is it affected different areas of the world at different periods of time. And so you can sort of take a look and say, okay, well, this happened in China. When actually car demand went up in China because people didn't want to do mass transit anymore. So actually, it was actually a plus for auto type companies. And, you know, you can see that early on and sort of say, okay, well, how different is the United States and the rest of Europe from that? When we pull out of this thing, is it gonna turn around? And that's one, I think, an example of something that, given the nature of the pandemic, is something that I think that could be observed, and something that you can really sort of take advantage of from that perspective.
Yeah, and the tough part is there's a lot more data that's coming out based, you know, ever since the pandemic broke out, so that we can kind of start to see, you know, some trends and what's happening in various parts of the world. But yet we're still so early in it. There's still so much we don't know from an economic perspective. I mean, you know,
well, I mean, the one thing for sure that happened was interest rates went down. So, I mean, the interest rates did go down, and what that does is, and it's really helped out. You know, it's very interesting. You know, when you look at, I think DeMotorin's done this study where he's shown that levered businesses have been hit much harder than unlevered businesses, which to a certain extent you think would be counterintuitive given the fact that the leverage is becoming cheaper. And so one way to take a look at this is, if you can find a company that you think is more than enough coverage and is going to go through this, their earnings should be higher on this side than the other side because their interest rates are a lot lower. So, I mean, there's some other interesting aspects like that, is in the fact that, I mean, part of the thing may be that a lot of these companies that do have a lot of debt a good number of them may not have the coverage. But if you can find companies that are in niches that have good coverage, solid coverage, and that can take advantage of these lower interest rates, they should do relatively well.
Got it. All right. Yeah. So Andrew, Geoff, throwing back to you again. We're going to do this like a snake draft. You know what I mean? So you're going to double question after this. So Andrew, Geoff, I mean, what are your thoughts on some of, not just what my question, but also some of what our panelists are saying?
Yeah. So the other thing is that we have some businesses that we own or that we look at or whatever, where there's also pent-up demand because of this. So they were closed for a while. And so those are unrealistic, those weeks where they were closed. But the weeks where they were open are also unrealistically high. There's going to be no period in this past quarter or the one we're in right now that was actually a normal period for them. There's no normal month for them, for some of the businesses. And, you know, and so that they kind of have to give us some information about that and what that means, especially in cases where, because of the in some states, the essential order, order to close down non-essential businesses and stuff, kind of discriminates against some companies that actually compete with each other. So you have some things like supermarkets or something which have earnings they've never had before and will never have again, because all their competitors who sell stuff were actually closed down while they were open. And in some states that makes a huge difference. And so they're gonna have to tell you these earnings are abnormal too, and this isn't going to be repeated on the upside that way.
I have nothing to add to that.
Absolutely. I mean, also digging into the question on, when you're actually looking at the filings as well. I mean, like I said, you guys do your podcast on a daily basis. You're looking at companies on a daily basis. I mean, is there, and also actually looking at it from a macro perspective here, never mind. I'm gonna throw you a different question. Here we go. From a macro perspective, and then really talking about the micros. And this is something that Dave also hit on a little bit just now, is that, we were seeing what typically happens when there's a downturn in microcaps. And yet the microcap, you haven't seen that really come back yet, because some of the, I don't know if it's the same money or different money that's now rotating into more, either just larger cap names or mid cap names. What's stopping people from then going back into some of these nets, or, just really quality names with quality balance sheets that, actually do have a bit of a moat and maybe not so much affected by the COVID pandemic. And yet people are still seeing these as more riskier investments than, let's say, some of these other large cap companies that have less strong balance sheets.
Yeah, so that's a good question. And somebody actually asked us a similar question on the podcast a couple weeks ago. They said something along the lines of, he referenced the Fed providing liquidity, the discrepancy between sort of our pond and everyone, it's a panelist on this podcast, our pond and larger cap stocks. And he's like, does that sort of discredit what you guys are trying to do? And I asked Geoff that, and for whatever reason, I just thought like a lot of people would probably be like, thinking Geoff to say like yes or whatever. And he's like, actually, no, it's only made it better because all the stocks in our pond really haven't bounced back as much as the market. So there's a lot more interesting ideas in everything that we're looking for.
Yeah, I think that when this sort of thing happens, people's time horizons shrink a lot. And the kinds of stocks that we're looking at tend to have lower, people hold them for longer. Okay, so individuals buy them and hold them for longer than professionals would before flipping them again. And I think that a lot of people are interested in being in for a shorter period of time. And that's almost always in bigger stocks that they do that. There's not a lot of people in high quality microcaps who get in and out really fast. That's just not what they do.
Absolutely. I think I don't know if it's the fact that sports was gone for 3 to 4 months or what was going on, but I mean, I think we all know what's going on to a degree, but to see some of the action that's been happening, on some small micro nano caps, that we'll leave it at that. I mean, it's pretty interesting to see what some of the stuff that's been happening, but yeah, I want to get back to some of my other questions, in the sense that, I also wanted to cover some of the challenges. Everybody joining us today are fund managers, asset managers and active managers, so I'd love to hear what were some of the challenges that you faced and then had to overcome and during this time period, or who knows, you might still be overcoming them. So like I said, it's going to be snake draft order. So Andrew, Geoff, going back to you, and then we'll go back around.
Yeah. So actually one of our biggest ones is we like to travel a lot to see people. And sometimes management doesn't really want to talk to you. Some other people don't really want to talk to you, but they will. And definitely COVID has been an excuse that they could use for anything if they don't want to talk to you. So it has become a lot more difficult to do some of the in-person talks that we would like to do. And that's a very important part of what we do. I think we probably do that more so than most people. And in some cases, it makes a really big difference for getting to know the people involved and stuff. Not so much for the information. You can do that over Zoom or whatever.
Mm-hmm. No, I would agree with that. And then also I would say, if anything, it's sort of just like was a good reminder as well of how important, I think Steve kind of talked a little bit about this, how important it was, or it is, to do research on a lot of companies and continue to build that watch list when stocks are at all-time highs. That's like when it's time to build that watch list and, continue to hammer and turn the page and find companies that you think are interesting and follow the story, even when you would never buy the stock today because of the price, and that's one thing that was sort of the biggest takeaway. And that's stuff that we preach every single day. But for me, that was sort of Geoff is invested through the tech boom, but for me, this was kind of like more of a more recent thing. And it's just reiterating just how important it is to do the work when stocks are at all-time highs and there's sort of no doom and gloom on the horizon, or whatever you want to say.
Yeah, this is definitely a tough time for us. Hey, I'm the same way as you, Andrew. I'm a worry ward myself, so this is like the most difficult time ever as a worry ward, you know what I mean?
Yeah.
So Keith, same question. What were some of the challenges you faced and overcome during this time period?
Well, I think some of the bigger ones have to do with just some of the business models and understanding what's really going on there and how the market seems to have placed a large value on companies that basically have future business models that may have some unit economics you can observe, but they're not observable in the financial statements. And so versus companies that have relatively good, economics today, and the market seems to be sucking money away. I find it very similar to what happened in the 0099 timeframe, where you had money being sucked away from fundamentally good businesses going towards businesses that had this future model. Now, the big difference between now and then, in my mind, is interest rates. In 0099, interest rates were 7 or 8% you could get on bonds. Now you're getting like 0 or really close to it. So I mean, in my mind, that makes a huge difference from a valuation perspective, but still I'm seeing I think there's a similar phenomenon going on. And I think after this, we may see something similar that happened. That after that, these models are very difficult to quantify, I think, how much they're worth. And what I've seen a number of people say, oh, the models are just doing great and there's a lot of momentum there. As long as these guys can continue to get growth and take share, then the prices go up. But it's, when you try to reconcile it with value, I mean, Ashlock de Motoren's done a pretty good job of that. Even a company like Netflix, you put in what you think are reasonable numbers or even aggressive numbers in terms of subscriber growth, you're still getting half the value. So there's still this X factor in terms of what's going on. So the market's saying, okay, I value the subscribers today. It's half of what the market price is. The market's expecting this additional sort of vertical that it's going to move into or adjacent market that it's going to go into, and you try and look for it, it doesn't really seem to be there. So there's those kind of situations. And in my mind, it's going back and concentrating on, okay, what are the key competitive advantages do these businesses have? Are there economies of scale you can take advantage of? And the other unique thing I think with these lower interest rates is some historically value investors have been pretty averse to debt. And I think that's probably a good thing in most cases. But if you've got a company that's got strong cash flows, they should be able to service the debt. And I think that's a real interesting opportunity now, especially since when you look at the data on leveraged companies, they've taken a whacking in this thing. And so I think if you look at some leveraged businesses, you're not going to put your whole portfolio in it, but I think it's a pretty decent bet that interest rates aren't going to go up very much. And if you've got a decent business that's generating a decent cash flow, in other words, you're putting together sort of like a public leverage buyout. And so in essence, because what you can do now is you can buy companies that, let's say, a private equity firm would buy and lever up, but you can buy those in the public market today and basically just get the same types of returns that they used to do. I mean, the issue with a lot of the private equity markets in these days is that the prices they pay for businesses is like 10 to 12 times EBITDA. But you can get businesses 5 to 6 times EBITDA that have good coverage that basically you can, and when you get those kind of parameters, historically, those have generated 20, 30% rates of return. And so I think there's some interesting sort of aspects of what's going on with interest rates that really help you out, because what interest rates do, low interest rates don't make capital intensivity as painful as it probably was before. I don't think that's really reflected in prices. All the companies are going up like crazy are these capital light businesses. So there may be some interesting capital intensive businesses that can actually have, that have a lot of barriers to entry because of that capital intensivity, and they can borrow at really low rates. So you have a really interesting combination, I think, now going forward for the next few years of that they should be able to generate incredible returns. And I think that's something that you looked at the past, you may not be able to catch all that, but I think that's something that's an interesting opportunity at this point. I know how we've sort of gone after that is we've looked at some of these pipeline businesses and said, okay, there's still the issue with what's going to happen with oil and gas, but you can look at these things and the way these guys are running these businesses, they're saying, okay, we've got all the pipeline built in and now we're just going to add little pieces on the edge. That reduces the risk and the fact that the incremental CapEx is really small. As long as gas doesn't like collapse in the next 3 or 4 years, which it probably isn't, it's a very interesting, I think, a very interesting space. And the fact that, as a matter of fact, one company in there, people, they have a very high dividend rate, 20% plus, and people were thinking the dividend was going to be cut, but in essence, management said, we're not going to cut the dividend because we don't have any more CapEx to do. In essence, we got our pipeline built out, or we're just going to add these incremental pieces, which doesn't add a whole lot. And so the yield was real, but that's probably an exception to the case. But I think I think looking at some maybe counterintuitive things that the market isn't putting a whole lot of value on some of these capital intensive businesses. The other thing too about small cap value, you look at the huge weighting in those companies. They're primarily financials, industrials, and real estate. And those are the segments, I think, that have really gotten hit hard. And there's even in real estate and other areas, I think those are probably areas of very interesting areas you can look at now. I mean, because a lot of the real estate stuff is, from a real estate perspective, I think there's some interesting opportunities in the fact where you can buy companies that are more of developers and in areas that are growing. And I think there's some interesting opportunities there too. And that's not going to be reflected in the balance sheet, but you need to understand sort of what's going on. But the market's just throwing everything out that's in those segments. So I think there's some interesting opportunities as a result of this. And I think going through this, for me, the bigger changes has been primarily looking at business models, reflecting upon the new ones, knowing they're going to affect it, but maybe the bigger opportunity here is basically look at these models that have been left behind and make an honest assessment of how much are these new models really going to affect them.
Yeah.
And then try to come up with an assessment. So almost sort of like a similar investment like an 00 and 99 buying like Berkshire, which would have been a contrary bet because everyone was going to the internet at the time, and saying, okay, well, these businesses that are still here, that are old bricks and mortar businesses, are still going to be here. But going through that type of an exercise, I think, is interesting. An area of potential opportunities.
No, absolutely. I mean, hitting on the point that you said earlier about how some of these companies that do have good cash flows and could take on the debt and handle that. I mean, we just had our keynote speaker in April, Dan Rasmussen. I mean, he's probably the main supporter. I think he'd be like, hell yeah, Keith, for sure. So moving to Dave. Dave, what are some of the challenges and that you face and then overcome?
Yeah, I think that, as always, controlling your emotions and your response to the price movements you see on your screen. And this is a practice that's valuable not only in times of steep bear markets, but just as valuable in times of extremely buoyant markets where everything you buy just goes straight up. I mean, when you buy a stock and it immediately works, it's up 20, 30%, and then a couple of weeks, you feel amazing. You feel like you're the king of the world. You feel like a genius. And exactly, you feel bulletproof is what you feel. In the same way, if you buy a stock and it immediately tumbles, or even if you did a ton of research and you love this idea, you're super confident, and it falls by a lot, you feel like an absolute moron. You feel like someone just had to come and drag you out of your house and put someone else at your desk and let them do the job instead. And doubly so, when you're managing other people's money, that represents savings that somebody sacrificed to put together, that somebody has invested carefully for decades sometimes, and now you're responsible for it. And so you feel awful when it goes down. But you have to be willing to accept that if you're truly an investor with the long view, and especially an investor willing to take on contrarian positions and not just chase momentum all day. So I found it helpful always to tell myself, after I have a string of big successes, I always say this won't last. And the same thing, after I've seen a couple of my positions go against me for a while, I tell myself, this won't last. And it never seems like that's true right then. It always feels like it's going to keep going that way forever. And same if your stock is going up, it feels like it'll never stop. But it always does. And so I think it's really, really important to think sort of counter-cyclically in terms of your own skills. You're never as much of a genius as you think you are after you've had a run of success. You're never as much of an idiot as you feel like after some of your positions have gone against you. And so some people are. No one here is, right, naturally.
I mean, I feel that way most of the time. That's why I do these things, so that I can try and be less of an idiot, but I digress.
I mean, yeah, we all have strokes of genius, and we all have periods where we're a moron. It's just the human condition. But I found that this is just another opportunity to really dial in on the way that emotions affect your investment process and on managing those.
Absolutely. No, that's good advice. And especially when you're thinking about, some people out there who, especially if they're out there day trading, who, speaking to something that Geoff said earlier, when you're talking about time horizons, and they're losing their jobs and they're seemingly taking even more risk and doing things that they might not totally understand what they're doing. And it's causing a lot of people to make those emotional decisions. And you, as an active manager, you have to work even harder to say, do not buy into this. Even if you haven't been through this bear cycle before, it's just, just take a step back. Let's go for a walk, or something, but again, now going to Stephen, what were some of those challenges that you faced and then overcame?
Well, to your point, it is difficult to make good decisions during times of stress. And it's understandable that someone who may have lost their job and then they get a stimulus check, they want to make it all back at once. So they want to play the lottery essentially. And we've seen some of that in the markets. I think the lack of information, the lack of reliable information, the uncertainty surrounding this information for these companies has been very difficult. As a value style investor, as I would describe myself, I think ultimately all investing is some sort of arbitrage. And there's three forms of arbitrage that I think you can take advantage of. There's time arbitrage, which is one of the, I think the best, in some ways, it's not easy, but the easier way to do it. Because if your time horizon, your holding period is simply longer, that you're looking at information longer, further out, you're willing to hold things longer out or indefinitely, gives you a tremendous advantage as an investor. And I think if you're going to rank those, that's the time arbitrage is the number one thing that you can take advantage of, that almost anyone can take advantage of, quite frankly, whether professional or not. And then the second thing is the information arbitrage. And that's where we're running into some issues here that it's not, in some cases, right, management can use this as an opportunity to distract, but in some cases, they don't know either. And even though it has been several months, that's again why I think it'll be very interesting for some of these Q2 reports to come out, just to see what that additional commentary is, especially with the smaller companies, to see what they're saying and how certain they are. Because quite frankly, I would trust the management a little bit more if they continue to act in a way that there's and communicate in a way that they're being conservative because of the uncertainty. They might not know how things are going to be in the next few months, and they should direct their company to operate in a way that reflects that uncertainty, so this company can permanently be a permanent kind of operator in some of these cases. So, and then the third thing is the emotional arbitrage. So I think it's time, information, emotion, and unfortunately right now we have to rely more on that emotional arbitrage than the time and the information arbitrage. And that's the most difficult out of the three, in my opinion, to have an advantage and to have long-term success. And that's not only from our own discipline and commitment and challenges as an investor, but you're also having to gauge the kind of emotions of the market as a whole outside of it and how they're going to react one way or the other. And that's where we get into the situation where you're buying into something that's a great deal. You're buying a company that is very, very undervalued. But if the emotion of the market is such that it's so negative over the short term, you could have an opportunity to buy it even cheaper a week or two from now. And I think that's what really caught a lot of us off guard when the market went down so quickly. I don't think any of us expected it to then go up so quickly. And I think we thought we had more time to buy into some of these, but the emotion of the market switched so quickly. And even, look at Warren Buffett. He really did not put very much at all to work. He was a net seller during that time period because typically he's more patient when putting things to work. And the market didn't really give an opportunity for any of us to hit any sort of the bottoms there.
For sure. Yeah. No, it everything just moved just at lightning speed. I couldn't even, it was just moving very quickly. So we're pretty close to wrapping up here. So I'm going to ask everybody, just kind of your final thoughts, really on anything, or maybe you want to talk about some things about, looking ahead for the rest of 2020. And then also following, when you're done with your answer, give us your website and where people can find more information. So like I said, Snake Draft, again, we're going back to Steven, and then we'll go back around.
Sure. Well, I appreciate that, Robert. Thanks again for having us. I think the word of the day is caution for the rest of the year. That's how I feel. I think it's a stock picker's market. I think those of us here on the panel need to remain disciplined, but also aggressive for the companies that we know very well, that we know are undervalued right now. And that is not the market as a whole. It's the things that we know and we own, and we have to keep that commitment and discipline. And I think we'll be justly rewarded for that over the next few years. And hopefully later this year as well. But I'm cautious for the market overall, and I'm worried. I guess, when Andrew said he was a worrier, I first thought he said warrior. And in some cases, I guess that's what we need here for the rest of the year, because you have to make decisions. You have to be tough as a warrior, even when you are worrying so much. And it pays to worry, certainly, but you still have to be able to pull the trigger when you see a great opportunity. And so I'm looking at that for the rest of the year. And I think the things that we own and the things that I know the other people on the panel own as well, I like these companies. And I think managers themselves will distinguish themselves because of that stock picking ability and analysis here over the next 6 months or longer. So I'll end on that note. You can find me at arquitos.com, ARQUITOS. And I also obviously am involved with Willow Oak Asset Management, willowoakfunds.com, a little easier to spell. And you can find me on Twitter as well at Stephen _Kiel, Kiel.
And frequent contributor to the Investors Roundtable. So,
Absolutely.
And frequent contributor to the Investors Roundtable as well. Sorry, I had a weird thing pop up, so I didn't know if you heard
it's fun to be on those, Robert. I appreciate the.
Absolutely, everyone's invited. That's on here, by the way. So just look out for that. It's a lot of fun. It's a lot more of the animated Bobby annoyingness, but I digress. Anyways, Dave, your final thoughts and where people can go and follow you.
Yeah, I would just say that no matter what kind of year you're having investment-wise, maybe you caught the acceleration and the disruption. Maybe you went all in on software and e-commerce earlier this year. Maybe you're having the best year of your life. Congrats, you deserve some kudos for that, but be cautious. And at the same time, if you're really struggling this year, if your stocks just haven't worked out, I mean, keep the faith. Cash flow still has value, maybe more value in a low interest world than it did before. And sooner or later, the market comes around. It takes time, but it comes around. So just keep at it, I guess. Yeah, you could find me at alluvialcapital.com. That's ALLUVIAL. OTCadventures.com is my long-running blog where I talk about weird little stocks that nobody cares about, but I do. It's fun. And I'm pretty active on Twitter as well at Alluvial Capital. So I hope I hear from some of you.
Very cool. And Keith?
Yeah, I'm a long-term optimist. I mean, I guess I think we all have a good idea of how this is going to end up in the end. I mean, things are going, my opinion, things are going to get higher. Life's going to get better. Things just continue to go up, and I don't see any of the main drivers of those key factors, which is basically making stuff cheaper for better so people live a better life, is really going away. So from a long-term perspective, I'm very, very, very optimistic about the U.S. in particular versus other places where they may have some aspects of capitalism, but they're not quite there with other aspects of, I guess, what you consider to be sort of a free way of doing things. So I'm very optimistic about the United States. I think, as Dave said, that there have been some sectors that have really been hit hard now, and I think it's just a matter of time before there's a rotation between these very high flute names. And as other people have mentioned here before, if your portfolio is very idiosyncratic, you shouldn't really be worried about the index. If you got some specific goals, and if you have a long period of time to do it, there's more than plenty enough time to make it work from that perspective. And so I'm really optimistic about that. I think that overall, the other thing I think that's this crisis I think has helped me and hopefully other people too is to add additional tools to their toolkit. I mean, before this whole thing started, these internet business models for me were just some sort of esoteric thing that maybe some VCs looked at, and I really wasn't a VC, so I really wasn't interested in it. But in my mind, what this has really caused me to do is to re-examine and expand the toolkits of things that can be done. Another thing that Steve's actually done too, and so another number of other investors have also done, is put on sort of these hedges associated with sort of extreme events. I mean, so I think there's a lot of things that investors can really, you can add to your toolkit, and then when the circumstance happens, then you can take advantage of it. In terms of where you can find me, I mean, we're We're bonhoeffercapital.com is the site. I'm on Twitter, Bonhoeffer KDS. But yeah, I mean, we'd welcome discussions, comments, anything that people want to talk. I'm always willing to talk. I've talked with a number of people just either on Twitter and email or just regular discussions. I'm always interested in trying to expand the toolkits. And usually when I talk with folks, it turns to be a very mutually beneficial discussion because there's different aspects that people bring to this business. And I find this to be a very exciting time to be part of this business. Whereas, you think about 20 years ago, this kind of stuff would never happen. You'd have interactions, but it'd be with a smaller group of friends. Now you've got the whole world, and everyone that's interested in value investing or investing in general, you get on Twitter and be part of the conversation, which I think is really exciting, makes everyone better, and adds some really interesting aspects of what's going on. So thanks.
I think we can all give some snaps to that, Keith. That was great stuff. So Andrew, Geoff, close us out. Final thoughts and where people can go and follow you on social media, subscribe to the podcast. Take it away.
Yeah. So my final thought would just be that this year I get lots of emails from people, and this year the big difference has been a huge amount of emails about regrets that they have. So I think missing out on the bottom of how cheaply they could have bought things and for how short made people feel that way. And I don't think it's a very good emotion for people to spend a lot of time on, because those prices don't exist now again. And it also may train you to learn from your mistake last time in a way that won't be good for next time, because it can make you feel that it's a really scarce. It can create the illusion of scarcity if something like that happens again.
Yeah, half those emails were from me.
Yeah. So I mean, just a tremendous amount of that. In a normal year, I don't get a lot of things about people's regrets for stuff that year, and especially not regrets about things that happened a few months ago. They might say, "Oh, I missed a stock 10 years ago, and I should have been in it the whole time," or whatever. But they don't say I should have been in this for the last 3 months or whatever. But I get a lot of those. So that would be the biggest thing, is to think about if you're spending too much time thinking about your regrets this year. Yeah, Andrew.
Yeah, I've had a couple people too that have reached out to me, and to your point, over a couple months, right? And I always tell them, I'm like, first thing, just forgive yourself, right? There was maybe a couple days where, with peak fear, peak uncertainty, when things got incredibly cheap. So really just forgive yourself and, stick to what you do. And pretty much I would echo everything else that Geoff just said, but you could find us at Focus Compound on Twitter, and you could find our podcast, which is just on Spotify or across pretty much every podcast platform, which is Focus Compounding, and our website is www.focuscompounding.com. So thank you so much to you, Robert. I think I speak for all of us here. You do a great job, and
thank you.
It's really appreciate you having us all on, and this was fun.
Awesome. No, I really appreciate having you guys on. You guys are such a valuable people, insights, everything to our industry. So, continue to share your thoughts, your insights, and just very thankful that you all joined me today. And just you indulge this half-wit. So I appreciate it. And I look forward to when we can all talk soon.
Absolutely. Thanks again, Robert.